This is Alan Bush with the Daily Financial Forecast for Thursday, March 3rd. Starting out with the stock index futures, we are seeing some pressure developing this morning. Looks like the economic reports that we did have earlier today coming in on balance, maybe a little bit weaker than expected. However, after just coming up from the trading floor, we are hearing that earnings are likely to be better than expected. At least that's what some of the floor traders are talking about. In fact, analysts now are expecting earnings in the fourth quarter for S&P 500 companies to be down only 3.7%. It was just the middle of January that expectations were for earnings to be down 7%. So that's somewhat supportive, even though it is a negative number, not as bad as had earlier been feared. So longer term, stock index futures, we believe, are headed higher, and it is the low global interest rate environment that will take stock indices to better levels for the balance of this year. Now, moving over to the currencies, the dollar index has had a very good run over the last month or more. In fact, we did see some monthly highs taking place in the dollar index just yesterday. However, today a little profit taking coming in. Longer term, though, we do feel that the dollar will be the best performer to the upside as interest rate differentials remain favorable to the greenback longer term. Also, we are seeing some pressure in the Japanese yen. Flight to quality longs being liquidated there as the global financial markets seem to be stabilizing to some degree. No longer a need to rush to quality vehicles, so the yen lower with that in mind. Also, we are seeing the Australian dollar higher for a second day on limited news, but yesterday we did have a report that the Australian GDP came in better than expected, so good gains yesterday and some follow-through gains today in the Australian dollar. Now, moving over to the interest rate futures markets, we are a little bit higher at the long end, the 30-year bonds trading higher. This mainly due to lower stock indices and lower energy prices. Also, even though it does appear that the Fed may be a bit more likely to raise interest rates later this year, possibly at the December meeting, of course that would be a bearish factor for the bonds. We are looking at the global picture, and interest rates globally, especially among the other major central banks, are likely to be very low, and in fact are likely to become even lower, and that will be long-term supportive to the 30-year bonds. As far as the probabilities of a rate increase from the Fed at the December meeting, that right now at about 59%, and that was, of course, much higher than what we had seen only about 2 weeks or so ago, where there was basically no chance for a rate increase from the Fed. So, once again, good trading, everyone. And remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.